What's the first thing that comes to mind once insurance is being made mention of? Financial protection, with car, home, property, you name it. And that brings us to our topic of today, Takaful, which is Islamic insurance. Hello and welcome to Islamic Finance Weekly. I am Rahma Say Muhammad. And in today's episode, we'll be discussing on Takaful, its meaning, its principles guiding it, and how it could be beneficial to you and your loved ones. And today with me is Mr. Ayonliri Ismail, Head Retail No Takaful Insurance Limited. Thank you, Mr. Ayonliri, for being with us once again.
You're welcome. Thank you very much.
Thank you, sir. A lot of people are not familiar with Takaful. Takaful is actually an Arabic term, and I'm sure it's a diverse world, it's a diverse country, and it's an Islamic term, and people are not really conversant with that term. And I would want you to shed light on what Takaful is, its meaning, and the different types of Takaful.
Okay, like you rightly mentioned, that Takaful is an Arabic word. So let us first dissect what's the meaning of Takaful literally. So Takaful simply means joint guarantee, and it's derived from an Arabic word, kafala, which simply means joint guarantee. And when we talk about joint guarantee, it relates directly to the principle of insurance, where so many people come together to contribute into a pool to compensate the unfortunate few among them who might suffer a loss. When we look at that and we relate it to the principle of insurance or the concept of insurance, which deals with what we call law of large numbers, it still speaks to the fact that so many people come together to contribute into a particular pool of funds to compensate the unfortunate few among them that might suffer a loss. So Takaful simply means a joint guarantee. Some jurisdiction calls it Islamic insurance, but to a large extent is a form of insurance that is in compliance with the dictate of the Sharia. So if we now want to look at it from the practical point of view, in relation to risk mitigation, risk control, because insurance itself is all about risk, mitigating your risk. The insurance company comes in to do what? To secure your risk for you. And when that risk crystallizes, the insurance company indemnifies you. So that's the concept of insurance. The same principle is applicable to Takaful insurance. In as much as we've said it is joint guarantee, it still speaks to the fact that I want to insure my property against a specified risk, so that when that risk eventually crystallizes, I'm indemnified by the insurance company. Who is the insurance company in this case? Is the Takaful operator. Who gets indemnified is the insured that we call participants under the Takaful model of insurance. Now, when we look at insurance in a strict sense, let me take it from the conventional point of view for me to explain Takaful so that we'll have a better understanding of what Takaful model of insurance is. The concept of insurance is all about a situation where we have the insured and we have the insurer. Insured is the customer. So an insured brings his risk to the insurance company and he pays a price. He makes a payment for that, which we call the premium. So an insured comes to insure his risk with an insurance company and he pays a premium to that, so that when that risk crystallizes, it gets indemnified by the insurance company. That principle under the conventional insurance practice is called a risk transfer mechanism. But when we now relate it back to Takaful, the tail end of every insurance still boils down to indemnification or benefit being paid out, claims being paid out when a loss comes up. But when we look at the Takaful model of insurance, one thing that differentiates it from the conventional insurance when it comes to the mechanism, like I've just mentioned, conventional insurance is a risk transfer mechanism. But under the Takaful model of insurance, rather than the claimant or the insured transferring his risk to the insurance company at a price known as the premium, we say under the Takaful model of insurance, you don't transfer your risk. You share your risk. And in sharing that risk, the participants who are the insured now, they come together to contribute into a particular pool of funds to jointly share their risk. That is the first contract. The contract between the participants jointly contributing into a pool to jointly share their risk What risk are we talking about? If I want to use motor insurance, for example, risk of accident, risk of theft, risk of damage to the vehicle. So if those participants come together to contribute into that pool, they are jointly sharing that risk and they are contributing for that purpose. Now, they will now employ the services of a Takaful operator to come and manage that pool of funds on their behalf, which is why we can relate that to another aspect of Takaful, where we say Takaful is a contract of donation. Contract of donation. That contract of donation speaks to what we call the concept of tabaru, donation, where participant willingly donates into that risk fund to compensate the few among them that might suffer a lot within that period of insurance. So that concept under the Takaful model of insurance is called risk sharing. So one major distinguishing feature between the conventional insurance and the Takaful model of insurance has to do with the risk sharing, which is peculiar to Takaful operation, and risk transfer, which is peculiar to conventional insurance.
Okay, what are the basic types of Takaful? I'm sure it has, types. Maybe there are different plans one could dive into. Or I want to do this plan or the other plan. What are the plans or types of Takaful that we have?
Thank you very much. In answering all of your questions, I will always want to take it from the conventional perspective so that people will have a better understanding of what Takaful model of insurance is. Now, when it comes to insurance practice globally, not only in Nigeria, is either of two types. General insurance or what we call life insurance. The same thing is applicable to the Takaful model of insurance. So if you're a composite insurance company conventionally, you can operate on the basis of life insurance, then general insurance. The same thing is applicable to the Takaful model of insurance. So if you're a composite Takaful operator, you have that liberty to operate both general Takaful, which is synonymous to general insurance in the conventional wing. Then you equally operate on the basis of family Takaful, which is synonymous to life insurance in the conventional wing. So as a composite Takaful operator, you can do both general Takaful and family Takaful. Now let us break it down. When we talk about general Takaful, think of what you know about insurance in relation to general insurance generally. The division is about 5 to 6 of them. We have fire, we have general accidents, we have motor, we have aviation, we have oil and gas, we have bond, we have miscellaneous. Those are the types of general insurance when it comes to the category. The same category is applicable to the Takaful model of insurance. What are we insuring? We are insuring those properties so that when a loss occur within the insurance period, the client, the insured, the participant in case of Takaful now, gets indemnified. So the same products under general Takaful is similar to what we have under the conventional general insurance. But the model of our operation and mechanism of Takaful is what differentiates it. Like I've mentioned earlier, I've talked about risk sharing, which is peculiar to Takaful, and risk transfer, which is the mechanism used under the conventional type of insurance. There are some other distinguishing features which I need to mention. Because when it comes to Islamic financial transaction, of which Takaful is a subset, Takaful is a subset under Islamic finance. When we look at those transactions, there are some elements that are objectionable, that should not be found when you are transacting businesses, Takaful inclusive. What are those objectionable elements? Number one is interest. Interest, riba. In Islamic finance, Takaful inclusive, riba is frowned at totally. It's not permissible at all. So whatever transaction you are going to do, whatever form of investment you are going to do with the participant fund that have bought one Takaful plan or the other, those investments must be ethical and should be totally devoid of interest. What alternative can we now use to give returns on investment to participants in the Takaful platform? Definitely we'll be talking about a profit-sharing arrangement. A profit-sharing arrangement. And to a large extent, we will now begin to look at what type of contracts will the Takaful operator have adopted in managing the participant fund, in securing their risk against a loss, so that when it happens, they get indemnified through claims. We might come to that later. Now, outside of interest, we have what we call garar. Garar simply means uncertainty, excessive uncertainty. That in an Islamic financial transaction or in a takaful transaction should not come up at all. Then lastly is what we call maisir, gambling. No, gambling in any form should not come up when it comes to the operation of takaful. Then let me quickly add this. Unethical operations takaful transactions should totally be devoid of unethical transactions.
All right. Thank you, sir. I actually wanted to ask what are the Sharia or rules guiding takaful, and you've just highlighted the whole of it, and that was insightful. And could you tell us the global view of takaful? Like, what do people around the world see? How do people around the world see takaful or the society? Do you think people are welcoming it or embracing it, or do you think people are shying away from it because they are not probably conversant with that method of insurance?
Thank you very much. Maybe before I answer that question, let me quickly say something concerning the Sharia governance, Sharia governance in relation to takaful operation. There is an additional level of compliance, and that additional level of compliance sees to the fact that the operation of the takaful operator should totally be Sharia compliant. And who are the people that will at least ensure that that is done in the process, in all the business transactions of the takaful operator? In Nigeria, for example, we call them the ACE, the Advisory Council of Experts. They are Sharia advisors. At least they are always on the board of the takaful operator to ensure that their transactions are compliant. And these ACE members, for all the business transaction the takaful operator does, inclusive of the product that is sold to the participant out there, they must ensure that it is fully Sharia compliant. They must endorse it. They must approve it before it is eventually sold. So that's an additional level of compliance to always ensure that the transaction of takaful operators are compliant with the Sharia principles. Now, back to the question you asked, the global view about takaful. In all honesty, as of today, takaful has become a global phenomenon. It has become a global phenomenon because of the principles behind it. It is fair. It is very transparent. And there is a concept behind takaful that is never found in the conventional insurance one. That future is the future of surplus distribution. Because to a large extent, when you insure your property or your asset, or even you do a life insurance under the conventional type of insurance, at the end of the day, when you do not make a claim within the insurance period, you have nothing that goes back to you. But in the takaful model of insurance, because we are only takaful operators are fund managers, managing the participants' fund, one, for the purpose of claims payments when that loss eventually comes up. Then for participants that do not make a claim within the insurance period, at the end of the insurance period, they will be eligible to what we call surplus clawback, surplus distribution. So it speaks to, the answers the questions that people have been asking. I've been insuring over the years. I've not claimed and nothing has come back to me. Why should I even continue? takaful has come to answer that question. So if you do not claim within that insurance period, at least you'll be eligible to a certain percentage of your contribution that will be plowed back to you as surplus. And that has been demonstrated in Nigeria over the years with the takaful operators we have in operation. Now, like I said, it's not, with that value proposition of takaful, is a global phenomenon. Naturally, it speaks to the mind of everybody out there because it will answer their need, it will cater for their need, and we equally give them something back at the end of the day. So when we look at the global takaful market, the analysis in 2021 was tagged at 73 billion US dollars. And the forecast is that in 2026, we'll be looking at close to about 103 billion US dollars, the global takaful market. And of course, when we look at takaful operators globally, we have about 324 takaful operators globally that cut across the globe, from Saudi Arabia, United Arab Emirates, Sudan, UK, Canada, and the likes. If we bring it down to the continent of Africa, we have about 40 takaful operators in the continent of Africa. You understand? And if we now trickle it down to our country, Nigeria, at least currently we have 4 full-fledged Takaful operators in Nigeria today. And we have so many of them that are awaiting their approval from the National Insurance Commission to get licensed and start operating. So when you look at this global market view of Takaful and the way people have embraced Takaful over the years, the market is just there. And the market, there is a whole lot of future when it comes to Takaful operation globally.
Yes. Takaful seems very interesting. I mean, it's interesting. It's user friendly. It's individual friendly. Everyone would want to embrace this method of insurance. Please, would you tell us the distinct feature or difference between Takaful and the conventional insurance methods?
Thank you very much for this question. In short, for every opportunity I have like this, I will always want to elaborate on the distinguishing features between the conventional model of insurance and the Takaful model of insurance. I've talked about the fact that Takaful has its source from the Sharia. So to a large extent, what I mentioned earlier, there's always an additional layer of compliance, which are the ACE members, the Advisory Council of Experts that are always on the board of the Takaful operator to ensure that their operations and their product are compliant with the Sharia. That's one aspect of it. Secondly, I've talked about the aspect of surplus. When it comes to surplus distribution, it's only peculiar to Takaful operation. It is not found in the conventional wing. And of course, that has answered the question of I've insured over the years, I've not made claims. What is the need for me? Should I continue? Takaful has come to answer that question. If you do not make a claim in an insurance period, of course, and that portfolio is profitable, definitely you get something back in terms of surplus. That's another distinguishing feature. I've mentioned one earlier, the concept of risk transfer and risk sharing. In the conventional insurance sector, the mechanism is risk transfer. In short, transferring his risk to the insurance company at a price which is premium, whereas under the Takaful model of operation, it's a risk sharing mechanism where participants share their risk. Takaful operator manages that fund on their behalf to either pay them claim or to distribute surplus at the end of the insurance period. Again, there is a clear-cut fund separation when it comes to Takaful model of insurance, where we have this shareholders fund distinctly, clearly separated from the participant fund, and those funds are managed separately. That's another distinguishing feature, because under the conventional wing, the moment you pay your premium, that premium is utilized by the insurance company in the way it has been structured. It's only when claims comes up that they come back to indemnify the insured. And so these are some of the clear distinguishing features. There are more than this, but of course, these are some of the salient distinguishing features. The Sharia-compliant aspect of it, the funds separation aspect of it, of course, the risk transfer mechanism and the risk sharing mechanism. Again, Takaful, like I said, is a contract of donation. Donation in the sense that participants donate into a risk fund, and the Takaful operator manages that risk fund on their behalf, either to settle claim or to plow back a surplus.
Yes. Thank you so much, Mr. Iron Lyric. That was an interesting session, and it was really insightful and educating. Thank you, sir.
Thank you for having me.
You're welcome. That was a talk on Takaful, which is Islamic insurance method and which is a tenet of the Islamic banking system. I hope you are able to pick one or two things or understand the concept of insurance in the Islamic banking system. And don't forget to keep up to date with us next week on the program. Follow us on all our social media platforms showing on the screen. I am Rahma Say Mohammed. Thank you for watching and bye for now.